Dhiraj Agarwal is with us, Managing Director, Ambit Investment Managers. Dhiraj, good morning. Good to have you with us here. Thanks for joining us. Let's just start with what no one is talking about yet, which is the budget, Dhiraj. I think because everyone is so busy with what's happening elsewhere and, of course, portfolios and markets going down, budget's not been on anyone's mind. What is your sense? I guess too late to ask you what the budget should do. Because I think it's all been. I don't think it's all done. I guess in that sense. But what do you think will happen? What are your, in that sense, expectations of what will be in the budget from a market standpoint, if any, Dhiraj?
So, interestingly, had you asked me this question even a while ago, what the budget should do, my answer would have been it's above my pay grade, because government will do what the government wants to do, and they've taken enough industry feedback. This budget, increasingly every single budget is reducing, the significance of the budget has been coming down in terms of its impact on the market. It's more of an accounting exercise, which is what it should be. Most of the significant changes now are outside the budget. So for example, even this year we saw a significant GST cut happening in September. Typically, governments used to wait for budgets in the past to touch excise rates and income tax rates. Now, budget is actually more of an accounting exercise, a summation of revenue and expenditure, and see how the numbers tally. From that point of view, I expect the current budget to be a little bit of a non-event. With 8.5–9% nominal GDP growth, there is pressure on how much tax revenue growth government can budget for FY27. The government, I don't think, will allow fiscal deficit to go out of control, which means there are very limited expenditure levers, this budget, in the government's hand. Either it is RevX or CapEx. So I think it's going to be a balanced, non-event sort of a budget. And after one day of volatility on this Sunday, we'll go back to life as usual on Monday.
Dhiraj, the hope was that markets after last year's underperformance will slowly start climbing higher. And that hasn't transpired, at least to begin trade with. And one of the drivers was earnings recovery. But Q3 earnings so far, at least, appear to be fairly underwhelming, not very exciting, lackluster. How is it in the stocks that Ambit covers? How have the earnings season been versus your own estimates? Are there more EPS downgrades? Because up until now, we've seen so much valuation derating, but will the EPS downgrades also continue to take place?
Even last year, we saw EPS downgrades, right? If you remember, FY26 also, we started the year with 16–17% earnings growth, and we closed the year at 7%. FY27, again, the consensus earnings growth the market is estimating is about 17%. And so far, I've seen marginal downgrades come in. I haven't seen upgrades come in. So you're absolutely right in saying earnings so far has been underwhelming. There was a hope or an expectation that post-GST cuts and very bold GST cuts in September, we should see a meaningful demand uptake and hence earnings coming through. Unfortunately, at this point of time, it looks like that the demand bump up was perhaps just 4 to 6 weeks, and it's already cooling off. So that's a sign of worry for sure. So I think you hit the nail on the head. We have to watch earnings more than anything else, because many parts of the world are seeing double-digit earnings growth, and if India doesn't, we may just continue to underperform.
All right, Dhiraj, good morning. Good to see you. But the last time actually we spoke, you were sounding a little bit cautious as well on the markets. Now the markets have corrected. Individual stocks have got smacked 10, 15, 20% as well. How are you feeling about the markets right now? Given the correction that we have seen, given the kind of sentiment that we're hearing, sentiment has got absolutely hammered. Do you think bulk of the bad news is gradually being digested and it's in the price? Or do you think we still have a long way to go and this is going to be a lot more painful before it gets better?
I don't know if it's got a long way to go in terms of absolute downsides, but I think this year continues to be a little bit of a struggle and painful. And so there are multiple forces at play. In absolute sense, you may be right that the valuations are no longer demanding and market should find a space. But at this point of time, India is suffering because of continuous FPI outflows. And FPI outflows are more relative than absolute. So as per Bloomberg estimates, Korea is expected to grow earnings 40%, Japan 12, US 13 or 14. Even Europe is more than 10. And I have a sneaky feeling that India will land at below 10 this year as well. So with continuous FPI outflows on one hand, continuous paper supply in terms of IPOs on the other, the amount of inflows domestic mutual funds are seeing is just not enough at this point of time to bring vibrancy back to the market. So I think this year will be a bit of a struggle year again. I don't know how deep the downside is, but it won't be an easy year to navigate.
You're saying FY27 EPS growth could be sub 10% versus expectations of 17%?
I think that's my personal view. I think it'll be sub 10 or around 10 or I'm not more than that. I see risks of EPS cuts. I see demand already faltering. I don't see any meaningful jobs growth happening anywhere. So, the one thing, the weak or tepid impact on demand from GST cuts tells me is we have reached a situation where just things becoming cheaper or interest rates coming down is not enough to revive consumption demand. We need jobs, we need income, and honestly, I don't see any strong signs of that at this point of time.
And maybe a little bit of deficit spending. It's above your pay grade there, as you said. But I think we need some...
That we'll have to ask the finance minister. It's way above my pay grade.
Most things are above our pay grades, Dhiraj. Greenland, EU, NATO, but the point is tariffs, right? But the point is we've got to deal with what's thrown at us. But, that question becomes important. And many have started to, once again, say why should that number be... Of course, not to go absolutely berserk. I don't think we will. It's been very, very disciplined on the fiscal side. But maybe, as you said, because just things becoming cheaper is not enough to revive demand. So maybe you need a little bit of pump priming as much as you can. But resources, of course, etc. We'll have to see if any of that happens. But you think possible?
No, I don't think so. See, when I sort of humorously or jokingly said it's above my pay grade. So, our job is to understand and read what the policymakers believe in and what they stand for, rather than continuously advise the policymakers to do what we want them to do. So when I said, advising the government on what should be in the budget is above my pay grade, my actual job at this point of time is to understand where this government stands. And I think the way this government behaved with a lot of discipline and restraint on spending, even during COVID, tells me that they will not bust the fiscal. Now, that's my reading. I may be wrong. It's a little bit of a crystal ball gazing here. But if they didn't bust the fiscal too much during COVID when the whole world was doing it, I don't think they will fall to temptation at this point. They might try and do resource mobilization from other sources like PSU privatization or sell-off or things like that and try and eke out some dollar here and there. But I don't think this government it's in the DNA of this government to bust the fiscal.
No, don't use the word bust, Dhiraj. No bust. Only maybe just increase spending, that's all I mean. But the point, Dhiraj, is that they've also changed track. Like, for example, 2 years back, the budget moved very clearly away from capex spending, right? This was the 2025 budget, right? So, they've also responded in that sense to what perhaps has been required. The other thing is, again, I'm just sticking with the budget on gold and silver. Actually, we've not even looked at the rupee. If you can just quickly pull up the dollar rupee and see where that is, because, that went to 91.94, if you can have the rate up briefly, because I think they've got one eye on the dollar rupee, of course, as well. So 91.75, there's about a 10 paisa appreciation in the rupee. Remember, dollar has been extremely weak against majors, against emerging market Asian currencies over the last 24 hours. So I think there is that. And again, like the Nifty, stark underperformance, rupee stark underperformance against EM Asia, of FX, etc. Gold and silver is what I was coming to, Dhiraj. You think there's a chance, again, with an eye on the currency, some are saying, well, an import duty hike is already is in the price in that sense. You think possible?
Yeah, it's quite possible that the government will do something about it, because despite fall in volume of gold and silver imports because of the prices, in dollar terms, it's actually significantly higher, right? And it's reaching a level where it puts pressure on our current account deficit, it puts pressure on the currency. So one could expect some measures by the government to sort of soften the gold and silver demand domestically.
It's possible, right? Basically, just to preserve dollars in that sense. I mean,
I think in absolute sense, the price of gold and silver is not really government's concern. I mean, like the price of equities.
No. It's about. I mean, the point is to curb demand and outflow of dollars. That's why I said.
That's right.
The
So
primary
concern is currencies. If you remember, even in 2017, under Chidambaram, the government had done some very aggressive measures to control the gold imports.
Yeah.
If you recall, 2013, in a span of just 6 months, rupee had lost 40%.
Yeah.
So this slide of rupee is actually slower than that, but it's still worrying. Yeah. So one can expect some action from the government on that front.
Dhiraj, we'll leave it there. Thank you very much for joining us. Good speaking with you. Always a pleasure.